I think that President Trump would like to get the share shift going again towards lower income tax rates and maybe higher tariffs. And maybe that's not a bad thing. I'm not a fan of any increased taxes, but it certainly did work well in the early days of our history. Here you can see, and this is updated for the latest real GDP growth and productivity numbers. We're around that 2.5% number for both right now. We'll get into this in a moment, but in the short term, given all of the uncertainties, we could see these dipping a bit until this administration has its programs in place.
Cathie Wood, the powerhouse investment manager and CEO of ARK Invest, has just blown the lid off Trump's economic genius. In a jaw-dropping speech, she unveiled the heart-stopping truth behind Trump's game-changing strategy: lower income taxes and higher tariffs. And guess what? It's not the disaster the media wants you to believe. This has historically worked wonders for the U.S. While Wood isn't a fan of higher taxes, she's quick to point out that this bold move is already producing real results. With GDP growth hovering around 2 to 2.5%, she warns that there's a short-term dip ahead due to uncertainty. But hold on, it's all part of the genius plan. Once Trump's initiatives kick in, prepare for a skyrocketing economy. However, Trump's strategy isn't just about numbers, it's about innovation and advancement. Cathie Wood stresses that the key to long-term economic success lies in pushing boundaries and sparking a technological revolution, something Trump fully understands. So, what can we expect next? As Cathie Wood reveals, the Trump administration is setting the stage for a bold economic future. Buckle up, because this is only the beginning. Let's watch highlights from Cathie Wood's speech for deeper insights. Like, subscribe, and enable notifications for more innovative finance content and expert interviews. Enjoy the video.
This chart is giving this administration license to cut spending and streamline the government in as many ways as possible, especially regulations, to stir economic activity. So the way to get the deficit down, so to get this line moving up, there are a couple of ways: actually cutting spending, which of course this administration is doing, raising taxes, which they do not want to do, except, interestingly, for perhaps private equity. We'll see if this time around the private equity tax breaks are eliminated. You know, philosophically, I don't really want tax rates to go up for almost anyone. I'm thinking, wouldn't it be nice to get the tax rates that private equity enjoys? So those are capital gains tax rates, 20%. Wouldn't it be nice to get those tax rates across the board in investing, including for companies like ours? We, of course, are subject to the maximum tax rate in terms of our own income. What about getting that closer to 20%? That would be consistent with a flat tax. So really paying a lot of attention to the direction taxes are going to go. And I think it's going to be very positive for the financial markets. The other way to get this deficit down is to grow the economy very rapidly, more rapidly than it has grown over time. And we think that is possible. I will get back to that when we get to our big ideas. We have a strong point of view about how much faster the economy could grow as this administration unleashes incentives for innovation and increased productivity, accelerated GDP growth. So we think the various programs are going to take this deficit certainly to where Treasury Secretary Bessent wants to get it, and that's 3%, minus 3% relative to GDP. But if this administration is successful in getting growth moving quickly as well, which we think it will be, we could get closer to that 0% mark. Now, here is the chart I was talking about. Tariffs versus income tax rates, both individual and corporate. At one point in our history, our early history, tariffs were the majority of government income. And you can see the switch in the early 1900s to income tax rates. I think the first income tax rate was 1%. And of course, now the maximum tax rate is, I think, more than 37% for individuals. I think that President Trump would like to get the share shift going again towards lower income tax rates and maybe higher tariffs. And maybe that's not a bad thing. I'm not a fan of any increased taxes, but it certainly did work well in the early days of our history. Here you can see, and this is updated for the latest real GDP growth and productivity numbers, we're around that 2.5% number for both right now. We'll get into this in a moment, but in the short term, given all of the uncertainties, we could see these dipping a bit until this administration has its programs in place. And the other reason it could dip a bit is because the velocity of money, I'll get into that in a moment, is already starting to slow. And so we'll touch on that in a moment. The dollar going up, combined with productivity gains, those are two powerful anti-inflationary forces, and we do believe they're going to work. So the market's fears about inflation reigniting, we think, are misplaced. The yield curve, this has been an interesting story over the last really more than 13 years. You can see that the yield curve, which is the difference between long-term and short-term interest rates, short-term usually are lower than long-term interest rates. But you can see the slope. We've been in a declining slope in terms of this yield curve for the past 13, 14 years. And we ended up in an inverted yield curve for a little more than a year's time. Inverted meant long rates were lower than short rates. That has flipped back around recently, and so we're going to be testing this downtrend. We could see a little more steepening. And we'll see if this downtrend has been broken. Why are we paying attention to this downtrend? I believe that the fixed income market has been sniffing out some deflationary undercurrents. And so long rates have not moved much above short-term rates because they are very much influenced by inflation.
Cathie Wood remarked that the present administration's attempts to slash spending and streamline government regulations are intended to boost economic activity and reduce the deficit. She stated that the administration is already undertaking budget cuts, but is not considering tax rises, with the possible exception of private equity, whose tax incentives could be withdrawn. Cathie Wood voiced a desire for a flat tax, citing the 20% capital gains tax rate as a suitable comparison. She also pointed out the necessity of rapid economic growth, implying that the administration's initiatives are intended to boost innovation and productivity. Wood believes that this technique might significantly reduce the deficit, potentially to 3% of GDP or lower. Let's go back to the interview and watch more clips to gain insights from Cathie Wood.
On to monetary policy, and here you can see money growth. I think we're up to 3.9% M2 growth on a year-over-year basis. You can see that in the purple line. The purple line tends to lead inflation. Now, you can see the purple line suggests that we could get down to 0% or less inflation generally, and you can see we're a bit stuck in the 2 to 3% range. Of course, the Fed is aiming for 2%. It's going to hang tough. And so we may see only 1 or 2 cuts this year if this inflation rate does not continue down. And now we think it will continue down for a few reasons. Rent is the stickiest part of this inflation rate. And you can see on this next chart where some early indicators of rent suggest the CPI rental inflation is going. So the black line here, you can see, is very, very sensitive to what's going on or has been in the last few years. During COVID, the new tenant rents, so that's the black line, soared into the double-digit range. And you can also see that since then, that rent indicator has been coming down and has gone negative. Now, the last time we saw this go negative was in 08-09. And that, of course, was a housing crisis. We believe the reason it's going down now, or one of the reasons, is because a lot of new rental units are coming onto the market. There was a huge construction boom and it really started after 08-09 as we were at 0% interest rates, and private equity money especially was looking for yield. And so a huge amount went into non-commercial, non-residential construction, so commercial construction, much of that in multifamily. And so we're beginning to see the early signs that that supply is coming into the market. And you can see it's a good leading indicator for the other much more lagged parts of the rental index. So those are owner's equivalent rent of residence. Both of these are in the CPI, and rent of primary residence. And so we think those numbers are going to come down from the 5-ish% range on a year-over-year basis down to 0 or even less, because the building over a decade period of time was quite substantial. And then the other reason we think inflation could continue coming down is velocity. So here you can see the velocity of money, which is the rate at which money turns over. It was part of the disinflationary movement in this century. The velocity of money was coming down. It was turning over at a slower and slower rate. So it was taking some of the firepower out of money growth. And you can see here, after the tech and telecom bust and that recession, we had a little bit of a lift in that cycle before it resumed its decline. And then in 08-09, we had less of a cyclical bounce because it was such a bad period, and there was a lot of fear in the marketplace. So the velocity of money continued to slow. It plummeted during COVID, as you can see, and we have had a bounce back, a cyclical bounce back, bigger than the ones we've seen in this century thus far. But it is starting to roll over, and you can see this on this next chart, the velocity of money on a year-over-year basis. It peaked around 11%, so it was adding to the firepower of money. And it has been slowing. It's now at 1.3% as of the fourth quarter. But if you do the quarter-to-quarter sequentially, it has started to fall, which means this is starting to work against money growth in terms of stimulating the economy. Now, if money growth is only 3.9% on a year-over-year basis, and the velocity of money starts falling or even just flattens out, goes down to zero on a year-over-year basis, which we think it will. There is a lot of uncertainty, new administration, a lot of fear as to what is going to change. There's a lot of excitement, to be sure, as well. But when it comes to the pocketbook, you'll find people will hold close until there's a little more certainty. So if we go down to zero here, then on a year-over-year basis, nominal GDP will be 3.9%. With inflation around the 2.5% to 3% range, that will not leave a lot of room for real GDP growth on a year-over-year basis.
Cathie Wood analyzed the current situation of monetary policy, noting the 3.9% year-on-year increase in the M2 money supply. She emphasized that this growth rate tends to precede inflation, implying that inflation could fall to 0% or less. Wood stated that the Federal Reserve intends to target 2% inflation and may only undertake 1 or 2 interest rate reductions this year if inflation does not continue to fall. She attributed the probable drop in inflation to a decrease in rent increases, a crucial component of the Consumer Price Index, CPI. She mentioned early signs of rent increase, such as new tenant rents, which have been falling since the COVID-19 outbreak. Cathie Wood believes that the increased number of new rental units entering the market as a result of the development boom will slow rent growth. This, in turn, will help to reduce inflation. Another reason Wood expects inflation to fall is a slowing in the velocity of money, which measures the rate at which money is spent and reinvested in the economy. She noticed that money velocity has been dropping since the early 2000s, with a small recovery during the COVID-19 outbreak. However, it has begun to roll over and drop again, which may work against money growth while stimulating the economy. Wood also spoke about the effect of tariffs on consumer morale and inflation expectations. She added that the Consumer Sentiment Index has been dropping, possibly due to concerns about increasing costs and tariffs. Furthermore, the predicted one-year inflation rate has grown significantly, which Wood attributes to concerns about tariffs and rising prices. This rise in inflation expectations could influence future monetary policy decisions. Furthermore, she pointed out the possibility of a reduction in real GDP growth if inflation does not fall, and warned that the present nominal GDP growth rate of around 5% may slip to around 3.9% as velocity declines. What do you think will be the most significant factor influencing inflation and economic growth in the coming year? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.